Hi, I'm Dan Aronson, U.S. Casualty Practice Leader for Marsh, and I will be your moderator for this panel, covering the new state of the market for real estate and hospitality, specific to casualty and financial lines. I'm very pleased to introduce today's panelists. We have Darren Cromwell from Marsh, U.S. Sales and Industry Operations Leader, Mary Henderson from Argo Pro, an underwriting leader for their financial institutions group, Kevin Maloney from Allied World, who is the North America Casualty and Real Estate Practice Leader, and Luke Testa from Chubb, North American Real Estate and Hospitality Underwriting Manager. During today's discussion, please feel free to ask questions during the chat function, and we will do our best to address those at the end, time permitting. So let's get right into our discussion. I imagine many of you have experienced current challenges in this marketplace. We had increasingly difficult renewal experiences prior to COVID, but things seem to have gotten worse since that time, since the pandemic really began impacting us in the US. And I know while insurance companies want to be commercial towards insureds in their decisions, I know many on the phone and many on this webinar are probably frustrated and even angry over the renewal process and their results. And they probably feel as if insurers don't really treat them fairly based on their own characteristics. We have had clients who have been shut down partially or completely for extended periods of time and are still facing very difficult renewals. Additionally, I can tell you that we have a lot of exhausted brokers out there in the industry as they try to navigate through this tough marketplace on behalf of their clients. So let's address the drivers of the market and also try to answer the question, do relationships really matter still? So Kevin, I'd like to start with you if that's okay. What were the pre-pandemic headwinds that the industry was already facing that led to the tightening and hardening of the market before COVID?
Sure, and thank you, Dan. It's an excellent question. Dan, when we look at a question like this, I'll harken back just a few weeks ago. I had chaired a Advising Casualty Currents conference, and then later spoke as a panelist at the Advising Big Nasty Claims conference. What we shared there, and there were brokers on the panel, and several brokers had commented that they've had clients in the short term within the last few years where on certain lines of business in particular, in casualty lines, they had had losses that had outrun the premium paid in those specific years. Obviously very concerning both to carriers and to clients as well, you know, because no one wants to see the industry itself head in that direction. So to your point, what are the headwinds that are causing, that were causing this even pre-pandemic? And you look at social inflation and the way that's played out in our court system. I think that reality television and athletes' salaries have so much desensitized the potential juror as to what constitutes a lot of money in American society. You take into account, along with social inflation, just regular inflation and inflation in the legal world where we all have to operate well on the claims side of our business. The cost of a single fatality in the United States brought to disposition, and this was from an industry study done by Advising in 2007, I'll even put it even more recent, 2012, the average fatality to disposition for an insurance company cost us on average $2 million for the single fatality. In 2019, that same fatality was going for $5.1 million. That's a 2.5 times percentage increase in just a 7-year period. There are very few, if any, investments in the United States that have yielded a full 2.5 times investment return. So as a result, we're seeing buzzings more and more regularly of litigation funding, of people who just want to get out and fund litigation to sort of rein on our corporate clients. You dovetail that with the anti-corporate sentiment and anti-big business bias that has really gone on for a while in our jury system, but has really come to a head over the last several years. The same jurors who won't hesitate to say, hey, how did you come out with this really large verdict, when they're, polled afterwards? Well, we took the number of the salary of the Yankees center fielder and extrapolated that out. I'm like, wait a minute, you're aware this guy was an iron worker, not a Yankees center fielder, correct? Oh, yeah, but we just thought that, he's not going to have any more lateral knee movement. I'm like, right, and he was never going to field a fly ball either, and he can go back to work, and you just gave him several $1 million. So that's very, very concerning to an insurance carrier. So I think the same people who are on those juries giving away the dollars are then angered when a corporate CEO makes millions of dollars. And it's a real bias. It's out there. So I think a lot of the ways that we as insurance companies were able in the past to keep the plaintiff bar honest was to push certain cases towards trial and make them have to earn it. They're not as afraid to go to trial as they were in the past because of the bias against big business and against our clients. And we've seen more nuclear verdicts, which was something that came out on those panels, which I hosted. Like I mentioned, we've seen the possibility of litigation funding, and you dovetail a lot of what's going on in the court system and the casualty losses with a more unpredictable and uncertain world. There's been no slowdown in wildfires, in named storms, civil, and now you combine that with the civil unrest and the global pandemic. It's been a very tough time to be a casualty insurer, and I think a lot of it is the uncertainty. And a lot of this, Dan, and to your point, really was prior to the global pandemic. And we were starting to see a turn in the market. We went through about 7 to 9 years where rates were down. I mean, as an industry, and then coming out of that, we were just coming out for about a year or two to really trying to maybe right set things a little bit in light of all of these losses. And then we got hit with the global pandemic. And one other point, Dan, and then I'll get off my soapbox for a moment. I've also seen a trend in losses, and I'm sure some of my other panelists have seen this. When we do a box review of the claims of different divisions, I'm struck by the increasing level of violence in the United States, in our society. It used to be that if you had a shooting, an assault, a sexual assault, or a violent crime at a location that we were insuring, it was such an anomaly that there was so much focus on that one claim. Now it's getting to be more and more commonplace. When you look through a multitude of insured submissions, you may see a shooting claim or a violent crime. And that's very, very concerning, because I don't think any of us go into renewal meetings thinking that someone may get shot or attacked and that type of thing. But in our society, we're starting to see more and more prevalence to tougher and much tougher claim scenarios. And with sort of a liberal jury pool against us, that's going to make things even more difficult, because when you look at things like the reptilian theory, the plaintiff bar is always very, very smart and creative towards expanding the duty owed by the client and the insurance carrier to safeguard the general public. It's one of those things we can see sometimes foolhardy loss scenarios where real American dollars are paid because we almost have to make our products, safe beyond any doubt, and people stop thinking about what's the actual duty owed in that jurisdiction for this product, for this location, to safeguard the public. And we're trying to make things, beyond safe, and it's a very, very difficult standard to hold our clients to. So, it's been a challenge, but I also think that, the best carriers can rise to the occasion and work with our clients towards the best possible results, even given a tough market.
So no doubt there was anti-corporate sentiment existing prior to COVID, as well as the strength of the plaintiffs' bar and how organized they were, taking on all the opportunities to really attack and through the tort system. Luke, let me ask you, what changed or what additional trends started coming in when COVID hit?
Yes, so all of the pressures that Kevin just discussed do remain, and I think what COVID has introduced into the marketplace really is greater uncertainty. In the short term, I think the biggest impact has been economic uncertainty, which has been felt most severely in the hospitality space. People simply aren't traveling, and that's reducing the need for hotels. We're seeing our customers project their go-forward exposures in terms of payroll and sales down year over year about 25 to 50% on average. And some assets that have existed for 100 years are closing. The retail, habitation, office space isn't feeling the economic hit quite as severely right now, We're told by our customers that they are largely still collecting rent, but it remains to be seen if that will change. If there's another surge in the virus and corresponding economic shutdown, particularly if the government doesn't respond with a large stimulus, you could see those spaces impacted in terms of how they're affected by it. And then long term, it remains to be seen what the impact will be, if any. Online shopping, working from home, if those remain long past the COVID virus goes away, that could impact those spaces as well. From a claims standpoint, it really remains to be seen, and there is a lot of uncertainty. So for example, in the comp space, there are 9 states and counting that have changed their presumption laws. Also, if there is an further economic slowdown, it remains to be seen if workers start to claim non-COVID related injuries to avoid COVID-related layoffs. And then from the GL side, it just remains to be seen how the courts and juries will view this COVID exposure. Of particular concern are large gathering places. So if, for example, malls, casinos, public entertainment venues, how will the courts and jury pools look at the exposure from a super spreader event that could occur at a property like that, or even smaller locations like a strip mall where 1 or 2 people allege that they caught the virus there. And we just don't know. It's a long tail business, and I think it's safe to say that the COVID claims will be with us longer than COVID itself.
So, I don't think we have the answers on how the COVID claims will play out, obviously. I do want to ask you a follow-up question though, which is really around relationships, right? Because understand the headwinds, understand the uncertainty, understand the trends that you and Kevin have discussed, but do relationships still matter for clients?
Sure. And I mean, I think the answer is absolutely yes. And in fact, in difficult markets such as this, I think relationships matter more than ever before. So for example, I had a difficult renewal recently where I think the relationship got us through it. It was a large client that had an office and habitational portfolio. And shortly before renewal, there was a fire at one of their habitational locations that triggered a large reserve. There was a death. For the second time in 5 years, there was this fire, and there was a death that resulted in $1 million BI reserve going up, but also $1 million PI reserve going up, all within 2 months of renewal. So you can imagine everybody was upset. I was upset because I didn't want to post a $2 million reserve. The client was upset. They didn't want to put a $2 million loss on their loss runs, particularly right before renewal. Marsh was the broker. They weren't happy to, be in the middle of all this. And what we did really is we fell back on the relationships that provided everyone with trust. We had been through difficult situations before, and everyone believed what the other side was saying. So we fell back to that relationship. With the client, it was over a 10-year relationship. We also, and I think this is important, had multiple lines of business. So, while the GL was hit by this claim, we also had a property relationship, workers' comp relationship, auto relationship, and an umbrella relationship. And what we did was communicate. I spoke to the broker in Marsh LA, Mario Ruiz, every single day, really, for 2 months. And what that did was, there were difficult discussions, but that dialogue always kept on going. So no one was really ever surprised. They didn't necessarily like what they were hearing on either side, but they were always hearing a point of view. We had several calls with the client to talk about what had happened, how they were going to try to avoid it on a go-forward basis, and what their challenges were, because there were some restrictions placed by the municipality that they couldn't do everything they would like to do. So ultimately, there was a lot of discussion, and we ended up renewing the account. It actually never went out to market, and we retained the business. There was a rate increase that was less than I wanted, more than they wanted, which is usually a sign that was a fair renewal. And then we also thought creatively and outside the box in order to mitigate the rate need, in that we put a retention on only fire losses and only at this location, as well as an anti-stacking endorsement, so we would avoid triggering 2 separate limits from one occurrence on a go-forward basis. And we, as I said, successfully renew the account, and hopefully we'll have the relationship continue for another 10 years.
All right, great. And after the call, I'd like to know how much you were paid by Martin Ruiz to say his name. We'll have a follow-up. So Mary, I'd like to transition over to you. We just heard about casualty trends and want to know what's transferring over into the financial lines and how would that be manifesting itself?
Yeah, thanks for having me. Definitely. Social inflation, that whole concept, it does translate to our world as well in the professional space, especially D&O. I'll touch on 2 points specifically. So with regard to D&O, in 2018, there's a Supreme Court case called the Cyan case, which actually determined that securities class actions could be brought in state courts as well as federal courts. So what that meant for us, because in general, defense costs, defending these claims has gone up. The costs have gone up in defending any type of D&O claim. It's just really e-discovery. All of the different factors have just created a real large increase in defense costs. So the 2018 decision by the Supreme Court allowed for plaintiffs to actually file simultaneously in the federal courts as well as the state courts. So you can imagine the type of expenses incurred in those types of situations, as well as there are certain legal hurdles that would have to be held in the federal courts that really weren't mandated in the state courts. So that really caused some alarm across the industry. And since 2018, there have been a number of cases filed simultaneously or in just state court alone. So there's a lot more tendency in the state courts to file more frivolous claims that may not have held the standard in a federal court. So that's caused issues in our space, and certainly that's something we've been monitoring for a long time, for the past few years, along with just in general expenses over the years have just increased. Another issue in our space, and I'm sure it's just, everyone's heard about the employment, our employment practices product, just the employment kind of Me Too movement in that space. So with Me Too type claims coming, the defense to kind of defend these types of cases, the settlements have become larger. It's just really increased a lot of costs in general in our space. So those are 2 major factors. I think what we're facing today in the current environment with COVID, there's just so much economic uncertainty, which we've been talking about, that there just creates that much more concern over the viability of businesses, bankruptcies, and again, a bankruptcy and a D&O situation, usually it means that obviously the D&O policy actually becomes part of the estate, and these carriers will have to pay in the event of a bankruptcy. And obviously with the economic uncertainty and the layoffs and the furloughs, this creates a lot more volatility in the employment related space. So these are the situations we're facing. And obviously in turn, what has happened in the market, and really it's occurred dramatically in the past couple of years, we've seen a trend, these trends happening. But since Cyan and definitely the Me Too movement, you've really seen it translate to lower limits. Obviously, across carriers are just not comfortable putting up as much limit on a particular policy. So contraction of capacity, definitely higher retentions, and really premiums gone up overall. So it's really impacted our space. I know it's impacted insureds, and they're seeing it, obviously translate in their renewals, which is, unfortunately, what the effect is of the costs and all the issues we've been facing.
All right, so let me ask you the same question I asked Luke. In your product line, how do relationships play in? Do they still matter?
Yeah, no, that's a great question. I think for us, when we're underwriting a D&O policy for on behalf of an insured, but employment related matters as well, really just getting the right people and getting the right people to the table to answer questions for us is key. So for me, any insured that is willing, or just any prospective insured that's willing to sit down and provide answers to questions. And obviously some of these are public companies. There's only so much information you can give. That's, obviously you don't want to give out some non-public information if it's a public company. But even when they are a public company, if you have the right people to the table, if you can get the CFO, if we're talking about the D&O renewal, or just the head of HR when you're talking about the employment practices renewal, and you're able to just answer questions very candidly. I mean, in this environment, in this economic conditions, I mean, the answers are not always going to be easy, right? Or they're not going to, you don't have the answers necessarily. I had a renewal of mine and it was a hospitality, it was a hotel REIT, right? So they had several hotels in the REIT. It was a publicly traded REIT. So again, there's only so much they could tell me that obviously they're a public company, but what we appreciated in that renewal, the CFO just, he talked about his relationship with his creditors. He talked about the relationship with his bank and all the different scenarios and how he really felt things were going to work out. He had nothing, he could never pinpoint anything. He really didn't know. There's so much uncertainty in that space. Obviously, we don't know we're waiting for a vaccine and what's going to happen. And when we don't know when people are really going to start traveling the way they used to. And I can appreciate that. So having that candid conversation and saying, worst case scenario, this is what we feel will happen. This is how we feel we can manage through it. And having those conversations is always such a valued part of our underwriting. And anytime we have a client that's willing to really get those people in front of you and talk through those difficult situations, in that situation, I had a whole different opinion of that risk after having met with the CFO and just the candor in which he answered those questions. And for me, that, the partnership and that real, true, honest relationship really makes a world of difference.
So it's relationship, it's trust, it's the transparency and really getting a comfort level with that client.
Right, yeah.
Great. So in the interest of time, Darren, I want to switch to a different topic. Around COVID, but what we have to do for the industry, different from renewals. We have frustrated clients. We have, I said, exhausted brokers earlier, and we have insurers that they heard have a lot of unknowns that concern them. And we have also various government entities that are weighing in on everything from compensability to immunities. So there's a lot of stakeholders out there, but not a lot of answers for a path forward. And I just wanted to see what thoughts do you have about how to address some of this on behalf of the marketplace?
Yeah, great question, Dan. So you're absolutely right. Clients are hurting, and uncertainty makes it extremely difficult for them to make decisions, whether that's around retaining employees, meeting financial obligations, when to invest in their business or reinvest. And so that's problematic. And the reality is the insurance marketplace didn't think they would absorb something like this, right? So we're seeing them respond by reducing capacity, not excluding infectious disease altogether. And so, unfortunately, even similar to, let's say, 9/11, right? Lenders may start to require assurances against this exposure. We can expect that. And so that's extremely problematic given the fleeting insurance capacity to hedge this risk. Fundamentally, I think, insurance creates the right economic incentives that drive change and can bend the risk curve and enhance mitigation. So I think the insurance industry definitely has a role to play. The size and scale of potential losses that we've seen with COVID, it's too large for the private sector to bear alone. The numbers just don't pencil out. So you're going to need the government balance sheet included if we're going to effectively take on this challenge. I think it's important to keep in mind that insurers were generally excluding this peril leading up to this, certainly on the BI front. And so they haven't been collecting premium, and therefore they need time to start to capitalize behind this risk if they're going to insure it. So that's kind of the need for a public-private partnership. I think if you just take a step back, the reality is this peril is here to stay. And given the interconnectivity of the world, it's just increasing the likelihood of future events. And so I also think that there will be a response where we start to use better risk management measures, contact tracing, you name it, to kind of bend that risk curve. So to answer your question specifically, I think that, a public-private partnership, a risk pool, is essentially the only way that we're going to create a viable insurance market for companies to hedge this risk. And then, just very quickly, I know we're running out of time, but I think the important characteristics that we've seen over the last 7 months in working with policyholders, working with carrier partners, as well as the government, we've kind of come up with a general framework for what we think the key tenets of a successful program will be. The first is affordability. That's why you need the government's balance sheet. I think initially there's a bill PREA that's currently in Congress, and they had set forward actuarial rates for pricing, and we know that that's just not going to work. So we worked with them, provided feedback, and that's since been removed. From a claim standpoint, I think any type of pandemic coverage, you'd want it to be a parametric trigger. Businesses need rapid payment, right, kind of during the eye of the storm, and so it's important that they get that mechanism right. I think it needs to work for businesses of all sizes. You've seen large businesses and small businesses, equally impacted and devastated across virtually all industries. And so I think just fundamentally, if you look at the three stakeholders involved here, successful program will drive the right incentives to help us bend the risk curve, as I've said. So from an insurer standpoint, having private capital at risk helps to drive the right incentives. We've seen, fully federally subsidized programs like the NFIP that has not been extremely successful with driving the outcomes that they're seeking. Policyholders, they're going to have skin in the game as well. There'll be a deductible period, and they should be rewarded for putting in good risk mitigation, techniques and standards. And then the government, as I mentioned, they're an essential part of this. We need their balance sheet to take it on, and that can help establish a market. And then, like what we've seen with TRIA, increased private participation over time, shifting some of the risk to the private sector, which ultimately creates efficiencies. So to answer your question, I think that public-private partnership is a way that we can kind of stabilize a marketplace and start to capitalize behind this risk, because the size and scale of it is really what makes it difficult to insure. The other components are all insurable.
Great, thank you. We have some questions we're going to address offline. I believe we are out of time. So first off, I want to thank all of our listeners and watchers. Really appreciate you taking the time out of your busy day. And really want to thank all the panelists for their transparency and for showing up today and sharing all of your information with us. So thank you, and we will speak to all of you soon.